So I worry about what I call a stagflationary debt crisis, because you have the worst of the 70s in terms of supply shocks and the worst of the GFC because of a too much debt ratio. And that combination is dangerous. I'm not Dr. Doom, as they called. I prefer to be called Dr. Realist.
Hello and welcome to a new episode of The Bull Club, Conversations with Leaders, in which we bring you exclusive insights from some of the world's most successful investors and financial leaders. I'm Elliot Gotkin. I'm a journalist, presenter, and creator and host of the FinTech podcast, and I'm thrilled to introduce an economist who sends shivers down the spines of perma bulls. Dubbed Dr. Doom for predicting the global financial crisis of 2008-2009, he now says the US economy has two options, either a severe recession or runaway inflation, neither of which sound particularly good. He's the founder of Roubini Macro Associates, and he has a new book out, cheerily titled Mega Threats, 10 Dangerous Trends that Imperil Our Future and How to Survive Them. And if that wasn't enough, I'm also joined by fintech innovator and crypto evangelist, eToro co-founder and CEO, Yoni Assia. So Nouriel Roubini, Yoni Assia, great to be speaking with both of you, and wonderful to see you both there in person at eToro HQ in Israel.
Thank you very much. Thank you very much. And for me, it's really a great honor and pleasure to have this webinar together with Nouriel. I've been a fan for a very, very long time. And actually, when we raised our C round back in 2015, all of the presentations of eToro included a quote from Nouriel Roubini from the World Economic Forum research on the future of financial markets, and it said social trading platforms have a very good opportunity to become something very big and influential in capital markets. And I always think it's good to hear different views about the market. I think everybody's interested in where the markets are going. Is this right now a correction? Is this a bull trap? Where is the economy going? And what can we do with our portfolios? How can we manage our risk in such level of uncertainty? So while I'm the perma bull and have always been very, very bullish about the markets, you have to listen to more experienced people to also remember that I'm a millennial and market cycles sometimes are 10 to 20 years. So you have to have a longer perspective, both from reading and from being there. So thank you very much.
Well, it's an amazing pleasure to be here with you. I'm a very strong believer in financial innovation and fintech, and eToro is an incredible platform in financial innovation, and you have created a fantastic firm. It's a pleasure to be able to have a dialogue on a regular basis with each other, to be here in Israel, and many congrats for what you've done. And I'm happy to have this dialogue. You know, I'm not a perma bear, as sometimes people believe. I'm not Dr. Doom, as they call. I prefer to be called Dr. Realist, but it's not as sexy as Dr. Doom. But you have to figure out what's going to happen to the economy, inflation, growth, and markets in a realistic way. And you can make money in good times and as bad times. And you have to be aware of the risk ahead as much as opportunity. So we'll have a great dialogue together today. Pleasure.
Perfect.
Great. Well, we're of course going to talk a lot about the risks and the opportunities. And I think one reason why people probably think that you're just a permanent doomsayer, Nouriel, is because I remember interviewing you when I was at Bloomberg Television, and it's always when there's a crisis on is when we kind of were most likely to interview you. So perhaps that gave the perception that you were more negative than you actually were, because we probably didn't speak to you when everything was as much as when everything was going great. But of course, as Yoni was outlining, we've got a lot of market volatility out there, seems to have kind of become the norm. We've got the Fed and other central banks battling soaring inflation with rocketing interest rates. So it's a very great time to kind of have you both there to get both of your perspectives. And I suppose, Nouriel, if I can start with you, and maybe we should start with the basics as to what's going on out there. We are seeing higher inflation, every day, whether it's in the UK or in the US, we've got, inflation that many people probably watching this haven't experienced. We've also got interest rates rising, which very, very rapidly, which again, many people watching this and many people who trade on eToro wouldn't have experienced before. So perhaps you can give us a sense of, what are the forces that are driving inflation higher right now, and how does the Fed raising rates keep a lid on it, or at least bring it down?
Well, these are a very important questions, so let me try to explain them in a reasonably simple way. Prices of goods and services usually go up when there is an imbalance between the demand for the goods and the supply of them. When there is too much demand relative to supply, then the price goes higher. Now, you have to ask yourself, what is driving now inflation that used to be very low in US, in Europe, and advanced economies? The target for central bank was 2%, but for a decade, inflation was even lower. And now inflation is going towards 8% plus in US, in Europe, and is already above 10% in the United Kingdom. So there are two sets of explanation. Inflation can go higher either because there is excessive aggregate demand aggregate meaning for the overall economy, or because there are a negative supply shocks that reduce the aggregate supply of goods and services. And depending on where we are in history, it could be more demand pressures and overheating that is driving inflation, or it could be negative supply shocks. Now, in the current circumstances, I think that the fair way to characterize it is both excessive aggregate demand and some negative supply shocks. Now, on the excessive aggregate demand, we know that central banks and fiscal authorities, when the COVID shock occurred and there was a collapse of economic activity, they were worried about recession, depression, and collapse of the market and the economy. So what did they do? They cut interest rates to zero, even negative in Europe and Japan, and more negative. They did what referred to as quantitative easing, buying bonds to push down even the interest rates on long-term bonds. They did credit easing by helping household, firms, corporations, banks, financial institutions from not collapsing. And the fiscal authorities did a massive fiscal stimulus, cutting taxes, transfers to the private sector, and more spending. So you had monetary easing, fiscal easing, and credit easing. Now, when COVID was severe, that was the right response to prevent an economic and financial collapse. But that stimulus was too much, too big, and too long compared to the fact that after a few months, we had a recovery from the COVID crisis. So we had this excess amount of stimulus that pushed up demand so much that has led to now inflation becoming high. That on the demand side. However, on the supply side, we also had a number of negative supply shocks that reduced the aggregate demand of the economy. Initially, COVID shut down of economic activity, supply of goods and services collapsed. Then we had the bottlenecks in the global supply chains because of the restriction coming from COVID. Then we had a reduction in the supply of labor. Many people not only became unemployed, but they decided to leave the labor force. In the US, people refer to this as being the great resignation. They wanted to work from home, having more flexible. They don't want to have the regular job. So you have the first set of supply shocks coming from the initial COVID. Secondly, this year, unfortunately, we had the Russian invasion of Ukraine. Not only is it very tragic and terrible, but the economic impact has been a sharp rise in the price of energy, both natural gas and oil, a sharp rise in the cost of food and fertilizers, because Russia and Ukraine produce and export a lot, and also a rise significant in the price of industrial metals, because both countries produce a lot of it and now the production and export is constrained. So that's a second set of negative supply shocks. Third, this year, China has continued again and made it even worse, is policy of zero tolerance of COVID. That means to shutting down entire cities, entire regions, entire part of the economy, the ports. That again creates new bottlenecks on the supply side. So both too much aggregate demand through excessive policy stimulus and a number of negative supply shocks that reduce growth and increase the cost of production. Now, how much of one on the other depends. In Europe, that is more exposed to Ukraine and Russia on the energy side, the supply shocks are more important. In the United States, where the monetary and fiscal stimulus was huge and excessive, maybe more aggregate demand. But throughout the world, in the US, in the European Union, in the UK, other advanced economies, we see now inflation going from below 2% closer to 10%. And it's a combination of both the supply shocks and excessive stimulus and aggregate demand. Now, what you need to do on the policy side? Of course, inflation is bad for many reasons. One of them being that right now, prices are going higher than wages. So real wages and real incomes are falling. And therefore, the direct hit on the consumer, on the household, on the worker coming from inflation. That's one of the many costs of inflation. So we have to reduce inflation to the target. And in advanced economies, the target historically of price stability has been about 2% inflation. Now, the way to do it is to use monetary policy, and you have to raise interest rates. When you raise interest rates, many things happen. You cool down the economy, and you cool down aggregate demand. You cool it down because when interest rates are higher, the cost of borrowing to buy a car, to buy a home, to have other consumer credit is higher. So people have a rise in their borrowing costs and they spend less. Also, when you have a rise in interest rates, it is what people refer to as a tightening of financial condition, because this rise in interest rate reduces the stock market. People have lower wealth, the value of their stocks, the value of their homes is lower. That negative effect on your wealth makes you consume less. So as you consume less, you're going to have a slowdown of the economy and a cooling off of the price wage inflation cycle. So that's what's happening. Now, the other thing that happens when you raise interest rates is when the economy becomes weaker, the unemployment rate becomes higher. Workers don't have as much pricing power of raising their wages. When the economy is lower and demand is lower, firms have less pricing power. They cannot raise prices as much. So you reduce inflation also because you're creating a slack in the labor market and you're creating a slack in the goods market.
You mentioned the unemployment figures there, Nouriel, because certainly in the US, we actually have been seeing pretty decent job numbers still. And we even saw inflation moderating a little bit. So some people who might be watching this might be wondering, well, hang on, isn't the Fed's rate rises, haven't they seem to be working? Shouldn't we, be being more optimistic now that maybe they don't need to raise rates as much and maybe inflation is now on a downward path?
Many validating points. On the inflation side, inflation in the US peaked at 9.1%, and during the last month, the number has been slightly lower than expected at 8.5%, mostly because the price of oil fell and the price of gasoline has fallen. But core inflation that excludes energy and food is still high at 6%. Secondly, you're right. The labor market in the United States is still strong, and there's a paradox because for the last 2 quarters, economic growth was negative, but job creation was positive. So we have technically what looks like a recession based on output, and demand is slowing, but the labor market is suggesting still a robust labor market. Now, the trouble is that the labor market is so tight, unemployment rate is so low, that wage inflation is still around 6%. And in order to achieve an inflation rate of only 2%, a wage inflation has to be around 3%. That is inflation plus productivity growth. So right now we're still in a wage and price spiral. Inflation has peaked, has fallen, but the target is 2, while inflation in UK is 10, in Europe is close to 9, in US it's 8.5. So it's not the time to declare victory. And because of that, I think that the markets are incorrect. Are incorrect because suddenly the market now say the Fed has increased interest rates 2.5. They've said they're going to go to 3.5. And they're going to next year stop and cut rates because inflation is going to drop like a stone. Unfortunately, I think that while inflation is going to start to fall gradually, it's going to fall too slowly. And therefore, the Fed cannot stop, cannot continue to raise rates only until 3.5. They have to go to 4, 4.5, possibly even 5%. Why do I say so? Even with interest rates at 2.5 today, and inflation at 8.5, real interest rates are negative, -6. So the tightening of financial condition actually is not enough to cool down the labor market, cool down the economy, and get to inflation to 2% by next year or the next year. So either the Fed continues to increase interest rates towards 4.5 and 5 to bring inflation to 2, but that risks to lead to a hard landing of the economy. Hard landing means a recession where growth continues to be negative, unemployment very fast, and that's going to cool the economy. It's going to reduce wages and inflation.
Unemployment rate.
Unemployment rate is going to have to go sharply up. Or if the Fed decides we want to avoid the recession, we want to avoid a hard landing, then they'll have to stop raising rates. But if they stop raising rates, inflation is not going to fall, and then we end up into a de-anchoring of inflation and inflation expectation. That's a dilemma. Now, the Fed says we're going to achieve a soft landing, not a hard landing, because we're going to be tightening enough that the economy slows down enough that the inflation goes to 2, but we avoid the recession and a rise in unemployment rate. I don't believe that's going to be possible because for the last 60 years in the United States, anytime inflation was above 5%, anytime unemployment rate was below 5%, and today inflation is 8.5, unemployment is 3.5. Anytime you have been in this condition, when the Fed has increased interest rates, we had a hard landing, a recession, rather than having a soft landing. So I think that unfortunately, we're going to go to a hard landing rather than a soft landing if we do want to achieve 2% inflation.
I have a question.
Yes.
Just because it's something I'm thinking about, like the process here seems like a very, eventually the process is government, right, or the Fed, trying to slow down growth, trying to make wages lower, basically making the poor poorer, right, because those who are with debt now have rising interest rates. So the poor become poorer to the point where they can't buy anymore, so demand slows down, and then competitive microeconomics basically mean competition will start lowering prices, right? That's the
correct.
Process to lower inflation.
Absolutely.
But that's a very you use one handle, which is interest rate, and then you need to wait to see how that trickles down. And one, in my view, eventually it's bad for the average citizen. If I compare this, for example, to Japan, who came to a conclusion that their interest rates remain around 0 and never went significantly above that for, I think, now 30 years. But also this process that started, usually I assume it's going to take 4 to 8 quarters till we understand really where are we in that process. Because none of these changes happen overnight.
Yeah. You make absolutely important and valid points. And there's a critique, of course, of central bank raising rates in order to fight inflation. And as you point out, if they do so and there is a hard landing, there'll be a recession, people are going to lose their jobs, and their wages are going to fall, and they're going to be worse off. However, the argument for raising rates and fighting inflation is based on several arguments. First of all, today, with inflation high, real wages are falling because wages are rising less than inflation. So the average person is already worse off. That's why people are starting to complain. That's why in all advanced economies, starting with the US, governments are not very popular because you have inflation. Inflation erodes real wages. That's the bad news. Secondly, if you don't fight inflation and you make the mistakes of being behind the curve rather than being ahead of a curve, then inflation expectation can get unhinged. they get de-anchored. People expect the prices are going to go up, so wages go up. Since wages go up, prices are going to up. And you end up into a vicious cycle of ever-increasing prices, wages, and inflation. And when that happens, like in the late 70s, then you need to have really high interest rates. At that time, when inflation was well above 10%, Volcker, that was the chairman of the Fed, increased interest rate to almost 20%. And then we had a huge recession to break the back of inflation expectation, but it took a double dip recession in 80, 82 to then fight inflation. So if you're behind the curve, actually, eventually, the recession is going to be more severe. The loss of jobs and income and wages is going to be more severe. So you have to be ahead of the curve. Final point I'll make that's important here. Some people correctly say this inflation today is not driven by too much demand. When there is too much demand, inflation is too high, growth is also too high. So when you raise interest rates, you're doing the right thing. You're cooling off growth towards potential. You're cooling off inflation towards potential. People say, this is a negative supply shocks that are driving inflation. Central banks cannot affect supply. They cannot affect what's happening in Russia, Ukraine. They cannot affect COVID. They cannot affect China. They can affect only demand. So why to raise interest rates to fight inflation if it's driven by lack of supply? The reason why, even if it's a supply shock, you have to fight inflation and cooling off the economy is because if you don't do that, inflation expectation become unhinged. And the example, you guys, and you are way too young, I have great hair, I remember the 70s, you were not even born, was the 1970s. In the 1970s, we had two negative supply shocks, Yom Kippur War between Israel and Arab states, followed by oil embargo, tripling of oil prices in 73. And then we had the Iranian Revolution, the Islamic Revolution in 78, 79, with another oil embargo spike in oil prices. Inflation went high because oil prices went high. There was a recession, what we call stagflation, recession and inflation. In both episodes, initially central banks and fiscal authorities said, this is a supply shock. We cannot do anything about it. They did not increase interest rates. They did not cool down the economy with fiscal austerity, and they remained behind the curve. And because of that, the inflation expectation price-wage spiral got out of control. Inflation became double digits, and then it took, in 1980, Paul Volcker to become the chairman of the Fed to cause a severe recession by interest rates at 20% that led to a severe recession in 1882 to then break the back of inflation.
You're saying it's all from the fear of hyperinflation. So to avoid getting into hyperinflation, which we understand will be much worse, we'll make some corrections to the current market. How do you compare that to Japan? Like if I look at the markets, and I always look, at the economy and the markets are trying to predict. How does this compare to the lost decade in Japan with the rising interest rates in the 90s?
Well, in the case of Japan, we had a lost decade of economic growth, of stagnation, but there was also the period of time where inflation became close to zero, if not negative. In Japan, what happened was that you had a recession caused by a collapse in aggregate demand because the real estate and the stock market bubble of the 80s went bust. Then there was a credit crunch. Growth became negative. Inflation went from positive to zero to negative. So that was a demand shock caused by a credit crunch and a negative aggregate demand. The response of the BOJ then was massive monetary stimulus, zero rate, quantitative easing, buying the bonds of the government, and massive fiscal stimulus to stop the recession and to stop deflation. And it took a decade because they started this policy too late to prevent deflation and return of economic growth. The last two recessions in the US and globally were also driven initially by a demand shock. When we had the global financial crisis, you had the housing bubble collapsed, you had a credit crunch and people could not borrow because they borrowed too much, and we had a recession in 08, 09, and we had deflation because there was a credit crunch and then a negative demand shock. So the right response was monetary and fiscal easing. And when we had the COVID recession, initially also, there was also a demand shock. Initially, output collapsed and we went into deflation. But then right after, demand recovered and we had the supply side. And therefore we had the negative supply shocks. So When you have a negative demand shock and you have growth and deflation, like the beginning of the global financial crisis, the beginning of COVID, the right response is monetary fiscal stimulus. But once you have a negative supply shock, like the continuation of the COVID problem, then inflation gets out of control if you have loose monetary and fiscal and credit policy. That's why we have to fight it now. Otherwise, we're going to end up like the 70s with inflation and with stagflation.
Nouriel, Yoni made mention of Japan. I should say thank you, by the way, because I was born in the 70s. But Yoni made mention of Japan. You've just mentioned kind of, the oil crises and the, high inflation and high interest rates of the 70s, 80s. We often look to the past to kind of get a sense of where things are going now. What previous crisis or what situation would you most liken the current situation to in history, so that perhaps our viewers can get a sense of where you at least think that we are heading?
It's interesting because on one side, the current situation looks like the 70s because we have the negative supply shock that are stagflationary. They're pushing us towards lower growth, eventually a recession, and keeping prices and wages high. So you have inflation and stagflation. But in the 1970s, interesting enough, we had stagflation, but we did not have a debt crisis because debt ratio, private and public, were low in advanced economies. We had a debt crisis in Latin America in '82 because interest rates at 20% on dollar in the US, with them borrowing in dollar, led them to a crisis. During the global financial crisis, we had the debt crisis because there was too much debt, housing debt, other types of credit in the economy. So we had the debt crisis, we had the recession, but we had deflation, not inflation, because we had a negative demand shock. And therefore, we had to fight it. Today, my worry is that we are having potentially the worst of the 70s and the worst of the global financial crisis, because we have, on one side, negative supply shocks that are stagflationary, but levels of debts are huge. In 2000, private and public debt globally, as a share of GDP, private debt is that of the household, of the banks, and of the corporate sector. Private and public debt was 200% of GDP. Today, globally, is 350 and rising. In advanced economies, 420% of GDP and rising. In China is 330% of GDP and rising. So we have huge amounts of debt. In spite of those debts, we have not had the debt crisis because we had zero policy rates, we had long-term interest rates low because of QE. So debt was high, but debt servicing costs were very low because we bailed out everybody. It was a zombie. We bailed out the zombie companies, the zombie banks, the zombie governments, the zombie corporations, the zombie countries, the zombie households. But because we had zero rates, because inflation was low, close to zero. But now inflation is rising, we're raising rates. As you raise rates, then people are not going to be able to pay their debts. Household, corporates, government, corporates, financial institutions, countries. And at the same time, we may have this stagflation that leads to inflation and recession. So I worry about what I call a stagflationary debt crisis, because you have the worst of the 70s in terms of supply shocks and the worst of the GFC because of too much debt ratio. And that combination is dangerous.
But the debt is all-time high, right?
Yeah,
because
absolutely.
we've been addicting ourselves to debt for decades now.
Absolutely.
And at those levels of debts, though, it's almost impossible in advanced economies now to move to higher rates, right? So if you move to suddenly 20% interest rates in the US, then what they need to pay on their debt is equal almost to their entire GDP.
Yeah.
So that tool doesn't exist anymore.
You're absolutely right, because with debt being so high, if you try to raise interest rate, not even to 20%, if the Fed funds rate in US were to go to say 5%, the problem, as you point out, is that debt ratios are so high that if you try to fight inflation by raising rates, you have a crash of the stock market, you have a crash of the bond market, you have a crash of credit markets, you have a crash of housing, you have a crash of private equity, you have a crash of all sorts of assets that are in a bubble. You have a financial crash and you have an economic crash. So you have a recession and a financial crisis. And therefore, The question that you have to ask yourself is, every central bank right now says, I'll be tough on inflation because inflation is too high. I'm going to do whatever is necessary. Hopefully, as I raise rates, I have a soft landing. But even if I have a hard landing, at least inflation goes back to 2%. My view is that there is a third scenario, not a soft landing at 2% inflation, not a hard landing at inflation at 2% with a recession, but a scenario in which, as you try to raise rates, you have an economic crash, you have a financial crash, and then the central banks wimp out. They blink and they say, I don't want to have a financial crash, I don't want to have a recession, let me stop raising rates. And once they do that, you get in the worst of all worlds, because then inflation expectation get de-anchored. Like the 70s, you get high inflation, you still have the negative supply shocks, and you get a recession, so you get stagflation, and eventually you need somebody like Paul Volcker to fight inflation with an even bigger recession. So because of the debt ratios, we are what people call, we're in a debt trap. Any attempt of central banks to raise rates to fight inflation leads to economic and financial crash, and maybe central banks are going to wimp out. But if they wimp out, then inflation gets out of control. That's a third scenario that is possible, where inflation gets out of control.
Although we've not seen a debt crisis yet, at least not in developed countries. I know certain countries like Sri Lanka, for example, are clearly suffering their own debt crisis. We've already seen some of what you've mentioned play out, not necessarily market crashes, but certainly big declines in valuations on stock markets, of course, in bond markets, and also, of course, as Yoni will obviously be very well aware, on crypto markets too. And in fact, on crypto markets, Yoni, we know that it hasn't been immune to brutal price corrections, and many saying that we're in the midst of a crypto winter. As a big believer in digital assets and an early investor in Bitcoin yourself, how do you see things unfolding?
So first, I think crypto markets behave just like every other sort of risk asset, right? So we moved on from risk on to risk off. The wealthiest people in the world and the institutional money managers have to take everything that they put in risk and then now move it to suddenly bonds, because bonds suddenly have interest rates, which they haven't for a while. So the allocation from everything towards fixed income is returning. And I mean also, by the way, on sort of more mass affluent people are looking now at things that have significantly less risk because of uncertainty. And that drives eventually also crypto prices. I think, from a long-term perspective, I think the more I learn about how, let's call them the tools of the trades of Fed policy, eventually it is to devalue all the currencies, right? So I think we're still in this midst of a currency war globally, while everybody's sort of chasing to reduce eventually the value of the dollar, the euro, and the pound, and to still maintain what is a 2% inflation target, but in my view, by the way, from the discussion, it's probably going to rise to 3-4, and it's impossible not to understand that, at least for the medium term, which is why I think Bitcoin as an asset is an interesting asset, because it's deflationary by nature. Digital assets as a whole is more about technology adoption. So I'm a very big believer in blockchain technology as a whole. I think the number of use cases are incredible in financial innovation, but it is talking about something like the internet. It's technology, and we'll see how that technology comes to play. And sometimes there's economic incentives in buying a token of a certain technology, but you need to understand really into each of those differently.
And I mean, whether it is with digital assets or conventional assets, I suppose with every crisis, there is an opportunity. And I'm not sure if we can yet describe what we're in as a crisis, but certainly the current situation we're in, as we all know, there are risks and there are also opportunities that come along that perhaps were not there before the current situation unfolded. Nouriel, you've obviously seen a few crises. I think you obviously were born, I think, perhaps before the 70s. What advice would you give people on positioning to perhaps younger, less skeptical investors who have only experienced the bull markets and the kind of almost, close to zero interest rates that we've had over the past decade or so?
Yeah, of course, the economic views imply a certain outlook for asset prices, both risky assets and traditional things like bonds. The answer on where the market going to go, of course, in part depends on what's going to be the economic outlook. For example, there's been a massive correction in US and global equities. Now there has been something of a recovery. Some people believe this is a bear market trap or a dead cow bounce. Some people believe it's going to continue. The answer to that question, of course, depends on whether we're going to get a soft landing. If we get a soft landing and we avoid a recession, inflation goes to 2, the Fed can stop raising rates, the market rally is going to continue.
But
If
your
it's
view
that,
is there's a low probability
but my
going
view,
into soft landing.
Yeah, but we have to think about, of course, the scenario. So my baseline is a hard landing, it's not a soft landing. That's why on equities, I believe that this is a bit of a bear market rally. And once the hard landing occurs, of course, in a typical recession, US equities go down by about 35%. So they went, say, NASDAQ more than 20, S&P close to 20, now they've reverted, so there is more way down. But I could be wrong. The soft landing equity are going to do better, but I believe it is more likely with a hard landing, and therefore the pain in equity and risky assets, in my view, is not yet over. But you have to think about scenario and the changing probability of the two. The other point, and I think that Yoni and I agree, is that right now we believe that there will be a secular rise in inflation. So the great moderation of inflation at 2% or below is over because of both negative supply shocks and loose monetary and fiscal policy. Now, we're not going to have hyperinflation, but inflation even at 4, 5, 6% is going to be much higher than before. Now, think about the consequences for fixed income, government bond yields. For the last 40 years, government bond yields in advanced economies were falling. And when the bond yield falls, the price goes up. So you make money because the price of the bond is higher. So for the last 40 years, we had low and falling inflation. We had low and falling bond yields. You made money on your equities. You made money on your bonds. And in typical portfolio 60-40, bonds and equities has done well. However, why we have a 60-40 portfolio, 60 equity, 40 bonds, or you have a 70-30, or variants of the same, like risk parity. The view is usually is that when equity do well, bond do poorly, and vice versa, meaning the price of bonds and the price of equities are negative correlated. For example, when risk is on, equity do well, bond yields go higher, the price falls. So you lose money on the bond side, you make money on the equity. When the risk is off, equity go down, but the price of bond goes up, the interest rate falls, and you make money on your bond. When there is economic boom, equity do well, interest rate rise, you lose money on the bond. When you have a recession, equity do poorly, but the bond yields fall and you make money on your bond. So price of bonds and price of equity are negative correlated, so you want to have a little bit of both. That negative correlation that worked for the last 40 years is assuming that inflation is low and stable. However, even if inflation goes only from 2% to 4 or 5, let alone more than that, what happens? When inflation goes higher, bond yields go higher. This year they went from less than 1% towards 3%. So you lose money on your bond portfolio. The return on bonds, long-term bonds, because of interest rates going from 1 to 3, was negative, double digit. And as inflation went higher and people worried about the Fed tightening, stocks went down for the first 6 months of the year. So for the first 6 months of the year, you lost money on your bonds, you lost money on your equities because the price correlation from negative becomes positive. The price of both of them either goes up together or goes down together. In this case, goes down together. So the implication for your portfolio is the following one. In a world where the great moderation is over and you're going to have higher inflation, you have to protect yourself, first of all, your fixed income, your bond portfolio. And having long-term bonds is a bad idea. It's a bad idea because with inflation higher gradually, bond yields are going to be higher, the price is going to be lower, you're going to keep on losing money. So what you need to do to protect your bond portfolio is several things. One idea suggested by Yoni, maybe some cryptocurrencies that are truly in negative supply, in limited supply, they may be deflationary, maybe Bitcoin, even if so far Bitcoin has not done well, even with higher inflation. There are several other options, however, I think are more traditional, but you should think about. One is to have inflation index bonds, because with inflation index bonds, when inflation is higher, the price and the yield goes higher, you don't lose money. Or instead of having long duration bonds, you have short duration bonds, because as inflation goes higher, the yield goes higher, reprices, and you make money on that. So you should have short-term bonds and inflation index, not long-term. Two, you need to have commodities that are a good hedge against inflation. Traditionally, gold has been one. Some of the other commodities like energy and raw material may be one. And third of all, on the side of the risky assets, equities usually do poorly when inflation is higher. Why? Because the discount rate at which you discount dividends is higher, with interest rates higher. And if you have a recession, of course, with stagflation, that's going to be bad for equities. In 1982, the S&P 500 price to earning ratio, that today is 20, was 8 when inflation was this high. So you want to reduce your exposure to equities, but there are other risky assets that are a good hedge against inflation. And one of them tends to be real estate, because real estate tends to be in limited supply. When you have inflation going higher, you can have rise in rents, and therefore it's a good protection against inflation. So I would say some people think about crypto, but short-term bonds, inflation index bonds, gold and commodities, and some exposure to the right type of real estate can be also a way of hedging yourself against the inflation risk as well. So you have to think of it in a creative way.
And we've seen
and I know
this
here in the most expensive city in the world, in Tel Aviv, that obviously that's one thing that people have been putting their money into, and I guess you would argue against 100-year Argentine bonds, Nouriel. But sorry, Yoni, you were going to...
Please.
No, I was saying we have seen significant increase in the interest in commodities for the first 6 months.
Yeah.
Huge spike in interest in oil, natural gas, wheat, which surprised us across the board. So I think our customers are understanding now how to trade commodities more. I've been teaching myself, forcing myself for the first time in history to actually open a short against the big indices. But that's a proportion of my account, right? So 10% of my entire exposure is now short the index, because my assumption is the stocks I bought, I'm still a very big believer in these stocks. But about 50% of my portfolio is equities, so I'm actually covering about 20% of my entire equities position in short, because my assumption is I chose stocks that I still believe in. I want to continue to, I don't want to sell my Google or my Apple, but I want to protect against potentially what seems to be, I'd say what I hear from a lot of the most sort of influential and experienced people in capital markets is there's a higher probable than not that the worst is not behind us, right? So
I agree on that.
In that case, you need to protect yourself. And I remember in the dot-com bubble burst, when I was still a very young trader, you were in the middle of the downtrend, and there were these corrections, and everybody was like, okay, it's behind us. And then another drop. And then everybody, okay, but the price of that stock was $30 and now it's $3. So it's 90% discount. So it has to go back to 6 and then it drops to 2. And then it's much harder to go back to the old prices. So there's at some sense sort of a reset of people's expectations of price, which is interesting because it's what you said about inflation as well. Sort of anchoring the price, anchoring the inflation number is similar to how people anchor the stock prices, right? Everybody's waiting to see that Bitcoin now goes back to the 67,000 because that was anchored. The same with stocks. People remember how they were basically, some stocks, a lot of the tech growth stocks that our customers love are down 70-80%. Now to go back to where they were is a huge opportunity from one end, but the question is how how can they go back there on sort of more, I'd say, financial modeling and not revenue multiples, which is how a lot of companies were priced at, but more traditional value investing, DCF modeling, and understanding how all of these different companies weather through a potential sort of very different economic cycle.
Of course, you talked about real estate as well, and we talked about the declines we've seen on the stock markets, in bond prices, in digital assets. I suppose one area where we haven't yet seen these declines, and perhaps we may not, is in real estate, particularly in developed markets. We still see, I think, prices rising in the United States, certainly here in Israel, and also I think in the UK, they're still, certainly on an annual basis, rising very robustly. And I suppose one possibility for those who are not wealthy enough to, buy apartments, which are out of reach of so many people now in these big cities, is to invest in real estate investment trusts. Is having exposure to REITs, is that one way, if you like, of perhaps seizing opportunities right now?
I'll just jump in and remind that we launched a real estate copy portfolio, which tracks a lot of the REIT operators. And I just actually also invested in it myself. So I think that's a great way on eToro to track real estate, is either buying the real estate operators, and that specific portfolio really aggregates on a location all of the top companies that does that. I'll say that from a real estate perspective, buying into the operators is different than buying the real estate itself. But if you know that the price of an asset is going up, then the ones who basically do the picks and shovels, the operators, usually do very well. So you're not exposed into, I'm not a big fan, by the way, of real estate. Because it's a very like you buy something, it's large sized, usually there's no fractional. In real estate, you need to have your lawyers, you need to have your mortgage into buying it, so it's a complex. I think for any person, real estate, for most people, is to buy real estate for where you live, right? As an investment, it's still very much reserved to mass affluent, high net individuals. But I think buying stocks of the operators of the REIT companies, etc., that's a very interesting investment into real estate.
Yeah, no, I agree with Yoni. Traditionally, individuals tend to have allocation to equities and maybe to long-term bonds, fixed income. But as we know, there are other alternative asset classes. Commodity is one of them. Real estate is one of them. Of course, there is hedge funds, there are private equity. There is other things that you can do. There is crypto today. But there are ways in which you can do liquid investment in some of these alternative assets. In the case of real estate, whether you want to buy the stocks of the operators, or you want to buy public REITs, and the public REITs invest both in commercial real estate, the whole spectrum of it, and also in residential real estate, you can get yourself exposure to the REITs that are actually, in my view, a reasonably good hedge against inflation. If you look at the, for example, 1970s stagflation, where equities collapsed between 1973 and 1982 by almost 60%, the fall in the real estate value was much lower than that, or a fraction of it, because, as I said, things in fixed supply tend to be a good hedge against inflation. So today there are ways in which you can have liquid investment. Of course, illiquid investments are costly. You want to buy your home, but you don't want to do illiquid investment into real estate, but there are ways of doing liquid investment in real estate, also in infrastructure, funds of various sorts of that sort. So definitely real estate will be an area to look at. Of course, if inflation...
We also have an infrastructure portfolio that we launched a couple of months ago, exactly because of that.
Yeah, I think infrastructure is a good idea for several reasons. Infrastructure usually is a good hedge against inflation. There are infrastructure needs all over the world in advanced economies, emerging markets, and many of the new infrastructure investments are for global climate change and resiliency. They're going to do well in the long run. So some exposure to infrastructure, again, through liquid funds of various sorts.
We're talking also about renewables. So
absolutely.
Because of climate change, there's the shift towards renewables. It's interesting, by the way, infrastructure is a good hedge because if there is high inflation and eventually the Fed or local central banks need to close it eventually, they'll go also into the political shift of just spending more, right? So they'll just spend more on infrastructure to give back employment at some point.
Yeah, we need to give back employment, and we also need to protect ourselves against global climate change and other types of major global tail risk. So infrastructure is a long-term investment, is a good long-term investment. Having some exposure to it makes sense, of course.
Investment advice for anyone watching: they should do their own research and make their own decisions. But Yoni, I mean, look, a CEO of eToro, you obviously have a great vantage point from which to see how your millions of traders are positioning themselves. What are you seeing? What kind of changes have you been noting? What trends have you been seeing since the start of this year?
Well, obviously, we've had the opposite of last year. Last year was a perfect storm of bull markets in crypto markets and tech. Anything you could say that anything you throw the rock at went up 30-40%. People thought it's making money in the markets is easy. I think, and by the way, from an industry perspective, everybody was afraid that you have this mass amount of retail investors who came into the market, but they're not well educated in bear markets. So 6 months into 2022, they're very well educated into bear markets. And again, there's nothing like learning from experience, and you should always understand how much you're willing to risk for that experience, for that education. But I do think bear markets created an educational opportunity for people. I fell in love in capital markets in the dot-com bubble, but I've learned the most in the dot-com burst. And I think right now there's a huge opportunity. What we see from a lot of our users is a bit of a wait and see mode. On crypto, volumes went down significantly, and people are in hodl mode. So by the way, which is interesting, very different than what retail investors did eventually in the dot-com bubble burst, is they capitulated, right? They closed their positions and they said, I'm done with it. We haven't seen any of that. Retention rates in eToro have never been better. Activity levels are lower, right? So people still hold their crypto, they still hold their tech stocks. They're not at the point where they're saying, I give up, I'm out. They just keep on hodling, trying to figure out what's the next step to do in the markets. And I think they're looking for some level of certainty, because we've been used to that level that everything constantly goes up. And I think that's also the reason why we wanted to do a lot of these webinars and conversations, to educate them about potential market cycles, that this market cycle might take longer. What could be interesting: real estate, commodities, exploring and understanding shorts. But we see a lot of interest in educating themselves and a lot of fear right now in the markets.
And I should say, I think the couple of $100 I put into Dogecoin just for a laugh is I've still held on to it, Yoni. So I'm sure I'm helping with those figures be as robust as they are. But look, unfortunately, we are kind of running out of time. So I want to just shift a little bit, because one thing we haven't really talked about is Europe. And especially about the weakness against the US dollar of the euro, which is roundabout parity now. Perhaps the pound is going there as well, because the British pound has been plunging. How much worse off are the EU and UK economies versus America's? Because often currency is kind of like a big indicator of what investors think about a country's economic prospects. And what are your thoughts on post-Brexit Britain, Nouriel?
Yes, my view on Europe, there is of course a Eurozone, European Union, and UK. UK is not a member of the EU any longer. Is that if my baseline, say for the United States, is a hard landing, a recession, then in my view the probability of that recession and of stagflation, it's higher overall for Europe. And by the way, in this case of the United Kingdom, as we know, inflation is already above 10% and is rising fast. And even the governor of the central bank, the Bank of England, has been admitting we're going in a recession, we're in stagflation. At least Chairman Powell says we're going to have a soft landing. The ECB says we're going to try to have a soft landing. I think in the UK they are admitting they've lost that kind of a battle. I think I'm more pessimistic about Europe, Eurozone, and UK for several reasons. First of all, their exposure to oil, energy, and trade with Russia is more severe, and therefore any shock to energy, food prices, commodity is more severe for Europe. This is a net energy importer. US is now energy independent. And in my view, the situation between Russia and Ukraine is going to get worse, unfortunately. Secondly, Europe and the Eurozone is also exposed to China trade-wise by being an exporter. US is exposed to China by being an importer. And what's happening right now is that there's a very sharp slowdown of growth of China, and the ability of Europe to export to China and have growth externally, if domestic growth is weaker, is challenged by the slowdown of growth of China. China might not have a recession, but growth going to 3% from 6% plus is effectively like a hard landing. So what's happening in Europe is that you have the same forces of supply and demand that are causing inflation high. Europe was even more behind the curve than the Fed in terms of tightening. The ECB barely started. The Fed started sooner. You have the exposure to Russia. You have exposure to China. So if when I have a recession in the US, that recession is going to be more likely to be deeper, more severe in the United Kingdom and also in the Eurozone. And in the Eurozone, of course, you have all the problems of the Eurozone, of having some fragile country, being a monetary union but not a fiscal union, and whether now political problems like the election in Italy may lead to the coming to power of a very right-wing, anti-Euro, anti-Eurozone populist government of the right, and then the spreads of the market may widen, and the ECB may or may not protect Italy or Greece against it. So there's a number of also political risks that make the situation in terms of economic and financial challenges greater for Europe. And the manifestation of that challenge for Europe is a weakening euro and a weakening pound. But when your currency weakens, inflation goes higher because you're having a higher cost of imports of goods. At least in the US, the dollar is strong, and therefore imported inflation is not the source of inflation. In Europe, you have domestic inflation, and you have imported inflation, and you have energy inflation as well. That creates this negative stagflationary shock that become more challenging. Because whenever you have stagflation, the dilemma for central banks is even worse. Because if you care about inflation, you should fight it, but that causes severe recession. And if you don't fight inflation, but you care about growth, then inflation expectation gets unhinged. So I find the condition in Europe and the Eurozone and UK more fragile. UK definitely already into stagflation right now.
It all sounds, particularly depressing, Nouriel. And I know that your current book does talk about, mega threats, but also how to survive them. Yeah. And we talked in the introduction about, perhaps being called Dr. Doom isn't a moniker that's justified for you. So how do we turn Dr. Doom into Dr. Sunshine and Roses? Tell us something positive that we can look forward to. I don't mean to say everything's going to be all right, but how can things be not as bad and perhaps, maybe even a little good?
I think, by the way, we talked a bit about that before.
Yeah.
As we talked about long term, right?
Yeah.
And technology empowering eventually decrease of costs. So what we're seeing now is shocks of supply, which eventually should get better.
Yeah, over the next few years, in my view, the stagflationary shocks are going to be dominant. They're going to lead to recession, inflation, and we've discussed a number of ways in which you can protect yourself, your financial portfolio over time. And therefore, if you take short position or if you have hedges, you can make money in good and bad times. We agreed that in the long run, technological innovation is going to increase the economic pie and it's going to reduce the cost of production. That's why, for example, during the Great Moderation, we had low inflation. Was, of course, trade and globalization, but was also technological innovation, the internet and all the other things happen afterwards. So an exposure to tech, to the industries of the future, whether it's AI, robotic, automation, machine learning, and all the spin-offs that come from it, or exposure to renewable energy and all the other industries of the future, is going to be a way of positioning yourself. Of course, there are risks in the short run because valuation of tech stocks, especially those that didn't have enough revenue and profits, were too high. They corrected. The correction, in my view, is going to become more when we have a recession, but then they're going to bottom out, and there'll be a long run, bull run into the right type of the tech stocks and so on. But you want to be exposed essentially to the indices of the future. Not everybody, of course, has access to private markets pre-IPO, but even if you are exposed to the NASDAQ or the equivalent in Israel or Europe of tech stocks, and there are ways of doing so, you get exposure to those firms and indices of the future. So the future is going to be one of hyper-digitalization, the way we live, we work, we study, we do commerce, we do business, we even socialize, is going to be technology-driven, and therefore I would say that that's the way you have to be exposed yourself. Now, technology has a little bit of a dark side, and the dark side of technology is the economic pie grows, but then the distribution of it becomes even more unequal, because tech innovation is capital-intensive, skill bias, and labor saving. So if you own financial real capital, you're going to do well. If you are in the top 20% of distribution of skill, education, and so on, and most of the clients of eToro are there, and you have enough financial literacy, you can do well. But if you are a low value added worker, blue collar, but increasingly white collar, or medium value added, your job, your income may be challenged by AI, machine learning, robotic, and automation. So you have to do the right financial investment, but you have to do also the right individual investment. The only way not to become obsolete is to become more skilled. Financial skills, economic skills, intellectual skills, knowing about technology, STEM, whether it's science, technology, engineering, computer science, and so on. So you have to think about your own personal human capital investment and your financial investment to diversify yourself. Because there'll be major disruption, there'll be creative distraction. Some firms, some individuals, some kind are going to go up, some are going to be down. You want to be with the rising tide of technology, and that's how you have to post.
Yoni, you have to promise not to replace me with a robot. Do you want to have some final words for you, Yoni?
That again, what I found out today, which is interesting, is Roubini is long-term bullish. So his view, he constantly talks about sort of what's coming next, and there's a high probability that the worst is not necessarily behind us. We need to remember it's very hard to predict the economy, and predicting the markets is like a derivative of that, because the markets are trying to predict the economy. But on the long term, I think a lot of our investors are investing with thinking about technology, about the future. The world is eventually going to get better, even though it's getting less globalized right now. And it's been a pleasure to learn and to talk, and happy to do that very soon again.
Yeah, my pleasure. You're very savvy and successful, and you follow market much more than I do. And it's been a great experience, and we'll continue to do so. It's really fantastic.
Thank you very much.
Thank you.
That just leaves it for me to thank both of you, eToro co-founder and CEO Yoni Assia, and economist Nouriel Roubini, whose new book, Mega Threats, 10 Dangerous Trends That Imperil Our Future and How to Survive Them, is out now. Thank you so much. I'm Elliot Gotkin. It's been a pleasure being your host for this latest edition of the Bull Club Conversations with Leaders, and I sincerely hope to see you all next time. For now, that's all. Take care. Bye-bye.
Bye-bye.